If you know a little bit about options income trading, it's got one major distinction from most other forms of trading in that with just about any options income strategy, you don't win in just one circumstance. You win across a whole range of circumstances, whether the market goes up or down or sideways within a predefined range. For example, you can set up an options trade that wins if a stock trading at say 300 a share closes anywhere between 250 and 350 on the day that the options expire. We'll show you how that basic trade can be set up in a minute, but then you'd logically ask, well, suppose that the market trades outside of that range of 250 to 350. Do you automatically lose? Well, the good news is that options trading is extremely flexible, and so the answer is no, you don't have to lose. You just have to learn how to adjust your trades to adapt to the new reality for the stock that you're trading, to widen the profit zone to accommodate the unexpected move that the stock has made. So if you're interested to learn how professional options traders adapt their trades to price changes on a stock or index, I think you're going to want to watch this video, so stick around. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we can provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, before you forget, go ahead and click our subscribe button right now so that you don't miss any of our free trading videos that we produce for the trading and investing community. So let's jump in. If you have a little bit of familiarity with options trading, then you might realize that there's a discipline within options trading known as options income trading, in which, to express it simply, you create a wide zone of prices over which you can make profit on a trade. And that is done by combining short and long options in different ways. These strategies have different names that you may have heard of, such as iron condors, butterflies, credit spreads, debit spreads, and many other names. Today, we're going to be discussing a fairly simple strategy known as the iron condor, which is a great way to set up a trade where you can win over a very wide zone of prices for whatever you're trading, whether it's a stock, an index, an ETF, or a commodity. So let's first explain how an iron condor works, and then we'll discuss the flexibility that I mentioned earlier. Now, most of you probably know something about options, but just for a quick review, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligations. The option, in other words, expires worthless because it was never triggered. Now, in a minute, we'll see how this idea of options expiring worthless comes into play when using the iron condor strategy. Now, before we go any further, I wanted to mention that we're actually running a free workshop where we'll be teaching attendees about 3 option strategies that options income traders, including those on our options trading desk here at SMB, employ on a consistent basis, including a really simple and powerful strategy that Warren Buffett and other great investors use all the time, plus an options trading strategy that has an 80% probability of profit statistically month in and month out, plus a really interesting and simple option strategy that you can employ with the stock that you like, where you make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you want to register for this workshop we're currently running, just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. You can also visit optionsclass.com to register for this free intensive workshop. It is an unusual opportunity for traders and investors to learn directly from Wall Street's traders, but that's exactly what you'll be getting through this free online workshop. So click the link, sign up for it now so you don't forget. Okay, so let's take a look at the price chart of a stock trading at about 1060 on November 1st of this year. So let's construct an iron condor which would win anywhere between the prices of 1,000 on the low side and 1125 on the high side. This is what that would look like on November 1st. Incidentally, this is a real stock and these are real options prices, but we're not mentioning the name of the stock intentionally so that you don't get hung up on which stock we're talking about. The idea is to understand the principles of the trade so that you can be creative and apply those principles to any stock or index that you'd like to trade. Okay, so here's an iron condor that we could have hypothetically set up with a winning range between 1,000 and 1125. So what we're illustrating is what's called an iron condor, which is comprised of a short call above the market at 1125, protected by a long call at 1150, and a short put below the market at 1,000, protected by a long put at 975. Okay, so let's go through each option and see what's happening here so you get the full picture of why we did this. On the downside of the trade, we've sold 4 puts at 1,000, 51 days out from expiration, which is, in this case, happens to be January. We got $19.45 for each option, and each option's contract represents 100 shares. So the total cash we received for selling these 4 puts was actually $7,780. We purchased 4 of those protective 975 puts as well, costing, as you can see, $5,700. Now, on the upside of the trade, we sold 4 of the 1125 calls for $21.85, which generated $8,740, and we went ahead and purchased 4 1150 protective calls at $14.30, costing us $5,720. So as you can see, the entire transaction actually netted out a cash flow of $5,100, which we get to hang on to if the stock closes between 1,000 and 1125, 51 days later. Why? Think about it, because if the market is lower than 1125 on expiration day, both the 1125 and the 1150 calls are going to expire worthless. No one is going to exercise the right to buy 100 shares of a stock trading at 1125 if the stock's actually trading below that. And similarly, no one is going to sell shares of a stock for 1,000 if the stock is trading above 1,000. So both the 1,000 and 975 puts will go out worthless as well in that case. Well, of course, that would be great, but what is our plan if the market pierces either price? You see, if the stock closes beyond the short call or the short put on expiration day, then that call or put will have value, and either we'll lose money by being forced to buy shares at higher than they're trading, or being forced to sell shares at lower than they're trading. In either event, we will lose money because that obligation got triggered. Our plan for dealing with that is called an adjustment plan, which sophisticated options traders use, and it's the way we manage risk on options trades. So, for example, let's say that we add a risk management component to this trade and make an adjustment rule that if the market gets within 5 points of either the 1,000 put or the 1125 call, which we're short in both cases, we're going to roll the short and the long option on that side further from the market price of the stock. So let's see what happens in that case by moving to November 20th, which is 19 days later, when the market on this stock actually got to 1,003, which is within 3 points of our short puts located at 1,000. Well, we have a choice here. We could be a sitting duck and hope the market doesn't keep going down, or we can employ what is known as a trade adjustment and roll our position down 50 points. What we're doing is closing the original position and establishing a new position where we're short 4 of the 950 puts and long 4 of the 925 puts. That gives us additional room so that if the market keeps trending downward, it has a further way to go before the buyers step in and begin to bid up the price of the shares at what they believe to be bargain prices. So after the adjustment, the position looks like this. Now, this adjustment is not done for free. The adjustment costs us some of that original credit that we collected. So let's see how that works. Now, as you can see, to buy back the 1,000 puts and close that position, we need to pay $15,780, and closing the long 975s actually gives us cash of $11,980. Also, we went down and sold those 950 puts for total cash of $8,640, and then we paid $6,560 for the 925 puts. So if you do the math, the total cost of rolling those 1,000 puts out of trouble was $1,720. So now, instead of having a profit area of 125 points, our profit range is 175 points. Although now we have less profit to walk away with, it's now down to $3,380 after we paid for the adjustment, which is still pretty solid. So now, with the same logic we just discussed before, if the stock closes anywhere between 9.50 and 11.25 on expiration day, then the reduced but still substantial cash, or $3,380, is fully earned by us, and we just pocket it and move on without any obligations. That's because anywhere between 9.50 and 11.25 means that all of the puts and all of the calls in the trade expire worthless, even though we had to give some of that original credit back because of the rolling of the position, in other words, the trade adjustment. Now, as it turns out, the stock did close at 9.80, which is below the original 1,000 puts on expiration day. We would have gotten killed on those 1,000 puts because they were so far above where the stock finally closed. Instead, all of the options of the existing position expired worthless, meaning you just pocket the $3,380 of options premium that you kept after paying for the adjustment. That's your profit. So, what I'd like you to take away from today's video is simply this. You don't have to be a sitting duck once you enter an options income trade. It's very simple to adjust your trades like we did in this case and roll the positions out of trouble and still have plenty of credit left over as your eventual profit on the trade. And incidentally, you can roll more than once and still have profit left in many cases if the market runs a little further in an adverse direction for you. But the main point to internalize here is that these trades just don't begin and end with the same position. Sometimes you cleverly move the positions around to accommodate what has happened to the stock's price and still have a winner on your hands. That's what the professionals do, and now you can do that for yourself now that you have the knowledge of how to adjust trades. Now, just to remind you, as I said earlier, if you enjoyed this video and you'd like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, or you can just head over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Hey, go ahead and click our subscribe button so you don't miss any of the videos they're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.